I want to walk you through what an FHA loan is, who it's actually built for, and the trade-offs nobody mentions until you're already at the closing table. FHA stands for Federal Housing Administration. The FHA does not lend money directly. Instead, they insure the loan against default, which lets lenders offer the loan with looser guidelines than they would on their own conventional loans. That's the whole structure. An FHA loan is a government insurance program wrapped around a regular mortgage, which allows more people to be approved more easily. The minimum down payment for an FHA loan is 3.5% if your credit score is 580 or higher. Credit requirements are more flexible than conventional. Some lenders will even go down to 520 in certain circumstances. And the FHA will look past collections, charge-offs, even past bankruptcies sooner than conventional will. For example, a Chapter 7 bankruptcy requires 2 years to pass for an FHA loan, but it requires 4 years to pass before you can get a conventional loan. And those flexibilities are the main reasons that FHA exists. Because if you have a lower credit score or recent credit events or a lower income compared to your debts, you may need to look at an FHA loan. Debt to income ratios can stretch much further with an FHA loan. FHA will often go up to 56%. In other words, all of your debts, including the home, could be up to 56% of your monthly income, and you could still get an approval, which is significantly higher than conventional, which ranges from 43 to 49.9%. And so if you have more monthly debt relative to your income, or if you have variable income like commissions or self-employment that may not be able to be counted for mortgage purposes, FHA gives you more room for approval. And FHA loans don't just approve you more easily, they often have lower rates too. People often ask me about FHA loans because they notice that the average rate for an FHA loan is often 0.5% lower than a conventional mortgage rate. And so they think, well, gee, if it has a lower rate and I'm already putting down a lower down payment, why wouldn't I just immediately go with FHA? Well, FHA loans are just like everything else in life, right? It comes with a trade-off. The biggest trade-off with FHA loans is the mortgage insurance. FHA charges two kinds of mortgage insurance. There's an upfront premium of 1.75% of the loan amount, which gets added to your loan balance at closing. So on a $400,000 loan, we're talking about $7,000, or basically half of your down payment, that gets consumed just by the upfront mortgage insurance premium. Additionally, there's a monthly mortgage insurance premium. And that ranges from about 0.15 to 0.55% of the loan amount per year, cut into monthly payments. And it never goes away, as if you put less than 10% down, that is. Okay, that's the other big trade-off with FHA mortgage insurance, is that the FHA mortgage insurance never goes away. If you put less than 10% down on an FHA loan, the mortgage insurance stays for the life of the loan, compared to a conventional loan where the mortgage insurance only sticks around until you reach 22% in equity. The FHA mortgage insurance over the years is significantly more expensive unless you refinance or completely pay off that loan. That's the only way to stop paying mortgage insurance on an FHA loan. Now, the monthly mortgage insurance was cut significantly in 2023. That's what made FHA genuinely competitive again for a lot of borrowers. Before that change, FHA was mainly used by people with scores below about a 680 credit score. And now you see people using FHA into the 700s. That bright line has become more like 720 or so. And one last trade-off is property requirements. FHA has stricter property approval requirements than conventional. In order to have a home approved by an FHA appraisal, the home must meet the HUD's minimum property standards. This means things like peeling paint on a pre-1978 home, missing handrails, or a roof with less than 2 years of life left can hold up an FHA approval until they're fixed. For new construction or recently renovated homes, this rarely matters. But for older homes or cosmetic fixer-uppers, this can be a real obstacle, and it's something to discuss if you're thinking about buying a fixer-upper with an FHA loan. That's something you really should be discussing with your mortgage loan officer and your real estate agent. So FHA is genuinely useful for borrowers who have credit scores under about 720, higher debt to income ratios, or past events that conventional just won't ignore yet. FHA loans provide true relief with easier buyer approval standards and lower rates, but they often come with higher mortgage insurance premiums and stricter property approval requirements. If you'd like to know whether FHA or conventional is the right move for you in your specific situation, just reach out or schedule a discovery call. I'll be happy to help.